Hello everybody. It is all known that around 90% people lose their money in the stock market. Then the remaining 10% must be having some secret. Thanks to Benjamin Graham, the secret was disclosed in 1950s. He did so in his book The Intelligent Investor. Basically, this book deals with the idea of value-based investing. First, what is value-based investing? In the short term, the stock market acts as per the people's perception. In short, it behaves like a voting machine, but in the longer run, the stock market functions on the basis of the value of the asset or the stock. That is, it behaves like a weighing machine. At least a minimum period of 3 years is separated for value-based investing. It is based on the real worth on the basis of the underlying assets of the company. Second, if we have all decided to go for value-based investing, when should we purchase the stock and what should we look after? A, we should not just be limited to 1 year or the previous year, but also the last 5 to 10 years must be looked upon. B, the informations are hidden in the footnotes and end notes of the financial statement, whether the company is treating its expense as its capital, whether the company is solely investing its money on acquisitions and mergers, or are there other things as well. C, some informations such as the ratio of current assets to current liabilities being at least 2:1. Also, the price of stock in the market to its earnings being around 15, and similarly the price of the stock to its book value being up to the value of 1.5 are some of the parameters that we can check upon. D, other items such as if the company is making the money, what it is using its income for. Is it just filling the pockets of the management? Is it just providing stock options to the management, or is it investing in a productive organic way? The creativity or the production are a thing to be focused upon. If the company is not giving the dividends, where is it keeping the money for? Is it just going to acquire some other company? Might be some important things. Third, the investor has got choices, not only the stock market, but traditionally bond markets have been quite popular. Previously, based upon 100 minus your age group, people would invest in the stocks. Say your age was 40, you would invest 40% of your budget in bonds and the remaining 60% in stocks. Similarly, the idea of mutual funds is widely preferred. In the longer run, in the very, very long run, the average return given by index-based funds such as the Dow Jones Index Fund is comparatively higher in the long run. Also, while choosing the broker or the management fund company, we need to be sure that the broker or the management can come down to our level and explain it to us. These are some of the choices we have. Let me just share you an example. In the decade of 1980s, Coca-Cola had introduced a new taste. It failed miserably in the market. The stock prices went down. While all the people were busy selling, there was one man acquiring all those stocks and piling them up. He was none other than Warren Buffett. Thus, we shouldn't simply be looking at purchasing and trading a stock. We should also be owning it. Thank you.